Hello, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is the founder of Adrian Day Asset Management, the man himself, Adrian Day. Welcome back, sir.
Well, thank you for having me, Ivan. Good to be
Yeah,
back.
it's an absolute pleasure having you back on Wall Street Silver. So, Adrian, the COMEX and LBMA, they're being drained of physical gold and silver at incredible rates. Do you believe this trend will continue into 2023?
Yeah, I think so. I think so. And the reason is because people have started increasingly to get nervous about the economy, to get nervous about things blowing up, like crypto, to get nervous about the financial stability. And so you're seeing more and more individuals, institutions, and governments buying gold, which is the first part of that equation. You're nervous about things, so you buy gold. And then, a reasonable percentage of those people are seeking delivery, because we all know that, when times are good, when things are going well, having ETFs, gold ETFs is fine, and having, gold held in some bank vault somewhere is fine. But when, as Danielle DiMartino Booth likes to say, when the peanut butter hits the fan, I love that. You want your sticky hands on the metal. And I
Right.
think more and more people are coming to that conclusion. So yes, I think it'll continue.
So, Adrian, what are you looking for specifically in order for precious metals to take off? Is it is it the Fed pivot or something else?
Okay, I said this actually back in April, and I don't think I've changed. What it'll take for gold and silver to take off is for more people to realize that the Fed cannot achieve its objectives. That is 2%, and we're already waffling on the 2%, aren't we? But 2% inflation, which in itself is preposterous because it's still inflation, 2% inflation without causing a truly horrific recession. When more people realize that, gold will start to take off. So the Fed doesn't actually have to, quote, pivot. And I don't really like using that word because
Right.
people misunderstand what you mean by pivot. We'll get to that if you want in a second. But let's say pause. I don't think the Fed has to actually change its policy. I just think more people have to realize that they're going to have to. And we're beginning to see that. If you look at longer term investor expectations and inflation expectations, the majority is still in line with the Fed. And that's whether you look at surveys, whether you look at tips,
Right.
whatever indicator you look at, the market is thinking that a couple of years out, the Fed will have it all under control. But interestingly, if you look at next year, investor expectations have shifted a bit. And whereas 3 months ago, the 1 year investor expectation was right in line with the Fed at 4.4 or something, 4.5% CPI. That's now shifting, and more people are thinking inflation is going to be higher next year.
You said earlier that people don't fully understand the term pivot. Can you explain that for us?
Oh, well, just generally, when people say pivot, use the word pivot, they think that the Fed raises interest rates and then the next day starts lowering interest rates.
Right.
And that's not really how it's gone. If you look at 2018, 2016, 2005, all of these other, quote, pivots, the Fed was raising rates, stopped raising rates for a meaningful period of time, a year or even 18 months, before they then started lowering rates. And so we don't have to see the Fed, raise rates 1 week and cut rates the next week. We just have to see them, for a pivot, we just have to see them stop increasing and at some point, change the policy. So that's why I prefer to use the word that's why I prefer to think of it as a pause.
Mm-hmm. What other commodities do you think will take off as well, other than just gold and silver?
Well, I think it's the commodities, not only where there is a growing demand,
Mm-hmm.
and a demand that is based on more than just a healthy global economy, but also where there's a potential physical shortage. And so primarily, other than gold and silver, primarily for me, that would be copper. Copper is the most obvious case,
Mm-hmm.
where, if you look 3 to 5 years out on any, even most conservative assumptions of demand, both from, global economy, from infrastructure in China, and perhaps maybe eventually in the US, and from electrification, both of vehicles and of the grid. But any conservative assumptions on demand mean we simply will not be producing the copper in 3 to 5 years to meet that demand, which of course means significantly higher prices. So copper would be my number one in that regard. I think oil and gas dynamics, a lot of that is politically driven,
Right.
but nonetheless, you can see the potential for genuine shortages of oil and gas in different places around the world. And then I think also uranium, although as I mentioned before, and I've argued with some of my good friends, I think uranium will be extraordinarily strong, 3, 5, 10 years out from now. But in the immediate term, I'm just nervous that there is excess capacity that could come back on. Not saying it will come back on. That's not the issue.
It could come back on.
I'm just saying it could come back on. And I like things where you're going to have a physical shortage.
Mm-hmm. Now, with all the chaos in the market, where is Adrian putting his money? Is it gold, silver, copper? Where are you putting it exactly?
With gold, you obviously have a lot greater choice of gold mining companies than you do silver mining companies. Right. As we know, an increasing amount of silver is byproduct silver. So if you're looking for a silver play, there are far fewer silver plays available to investors than there are gold. But I like both. I like gold. I like silver. Silver potentially has, as we know, much more leverage in a strong market, particularly in an inflationary cycle. Silver can outperform, and in fact, we've seen that. If we look back to where silver bottomed at the end of August, beginning of September, it's well outperformed gold in that time. Mm-hmm. But all three. Gold remains the base for me, because gold is not just a good investment, and in gold stocks, investments on which you can double and triple and quadruple your money, but but it's also a hedge, it's also insurance. And so, gold for me belongs in a portfolio in various economic environments, and will do well in various economic environments, scenarios where maybe copper and silver maybe won't. So I prefer gold as the base.
Yeah, well, that's good. As long as you like silver, then we're happy.
I like silver.
So, Adrian, there's massive protests that are breaking out all across of China. You're seeing it at the Foxconn factory, where iPhone reportedly is losing almost 10% of their production on the new iPhone. So it's really hitting hard, and people are sick of censorship. What are your views, and can it spill over into the US and in Canada and the West?
I think Canada and the West is maybe, past the COVID, although I think we have to be a little bit vigilant for the fanatics to want to bring back restrictions. But I think at the moment we're sort of past that to a large extent. No, the protests in China are really interesting from several points of view. The way that they were pretty spontaneous, but gathered speed very, very rapidly. That's number one. Number two, what I think the most important thing about it is the reaction of not the central government so much, but the reaction of the regional governments in several cities, Beijing included. You've had local governments back down if you want, or retreat,
Yeah.
or ease, whatever word you want to use, but back down in the face of protesters, which is astonishing. I think Beijing, for example, will now allow people to go back to their apartments, even if there's an infected person living in the apartment block.
Hmm.
Wow, that's nice.
Well,
But
the huge thing, Adrian, which is crazy, I find, is in Shanghai, the restrictions were so serious that the Chinese government, they were locking up apartment doors, like they were locking them
yes,
down so nobody can leave them. And then a fire broke out in one of them, which killed like a bunch of people because of the restriction. They locked up literally the apartment doors.
well, that's what really started the protests this
Yeah,
time around, isn't it?
yeah.
So I think the fact that local governments, and they're obviously doing it with the approval, or certainly not the disapproval of
Hmm.
the central government. So I think for Xi to back down would be maybe a step too far to expect in an authoritarian society where he has, pinned his flag to,
Right.
the COVID lockdowns. But several cities, not just Beijing. Beijing was the one I just mentioned with the apartment building example, but several cities have eased those restrictions. So that's very significant that the governments are acting in response to protests. And what does that mean? Well, if this continues, if I'm
Hmm.
right in saying that obviously the central government gave tacit approval to this, if that's correct, uh, then we're going to see several things. We're going to see China's economy pick up a bit. That means more demand for resources and commodities,
Right.
very strong for our sector, not necessarily gold and silver, but very strong for commodities generally. It means the regional economies will pick up, and with it, the regional currencies, perhaps the Australian dollar and some of the, not that we or your listeners probably invest in the Vietnamese currency or the Thai currency, but
Hmm.
it will mean that those currencies will pick up. Not necessarily the Chinese yuan, because as the economy opens up, the first thing that will happen will be greater imports.
Right.
Although you will get an increase in exports as well, as you mentioned, the Apple factory is a good example, but it's not necessarily a one-way street. So, but it'll be positive for the region. It'll be positive for the stock markets. Hong Kong should benefit. Macau, with the gambling, that should benefit. But from our point of view, the most important thing, I think, will be a pickup in demand for commodities.
Hmm. Do you think that like from people looking outside of the world and people on in China, do you think they look at Xi Jinping now and say like he's losing kind of his authoritarian power if they roll back and step back on all of these measures?
Um, I'm not. I don't pretend to be a China expert.
Hmm.
I'm not sure. I mean, I think his electing himself for another term
Hmm.
has maybe made the more thoughtful people think a little harder, because that's unusual. That's nothing like that's happened since Mao Zedong.
Yeah.
And I mean, Mao Zedong was probably one of history's most vile monsters, but he had a certain stature that this guy doesn't. I mean, he
Right.
won the Civil War after all. So I think there was probably, I suspect that there was some sort of resentment against him doing that.
Yeah.
But I think it's far too soon to think that this is going to break the government.
Yeah, I agree. So, Adrian, before you go, do you believe the Fed will actually reach their 2% target, or is it just laughable?
I didn't think we could finish one of these interviews without discussing the Fed, but I won't rant for 20 minutes. Don't worry. No, I think it's what I will say with 99% certainty is that there is no way the Fed can achieve a 2% inflation target and have a soft landing. Actually, that's 100%. Powell and Yellen still seem to think that although they backed away from their certainty, they still seem to think that it's possible or likely. I forget the last word Jerome Powell used. But no, so I'll go further than that. I don't think there's any chance that they can attain their 2% target without causing a serious recession. Do I think they will do I think that they will achieve 2%? I don't think so. I don't think so. And, one of the things that's critical for people to remember, Powell mentioned at his last conference or in the last communique from the Fed, they talked about lags. Remember, they added that language about how monetary policy works with long and variable lags. Obviously, they knew this before, but they emphasized it this time as a justification for their
slowdown,
upcoming slowing. That's critical for us to remember. And interest rate sensitive sectors like housing, like automobiles, where most people borrow money or a lot of people borrow money to buy houses or cars, those are affected sooner than other sectors. The point that we have to remember is that the economic impact of what the Fed has already done, forget December, what they've already done has yet to be felt.
Oh, serious? So you think it's not even felt yet?
Absolutely. I mean, you look at employment's an obvious example. I think we've talked about that before, but let's look at consumer spending, for example. You look at consumer spending and it's remained there fairly flat. It actually picked up a little bit last month. If you've got 8 or 9% inflation and consumer spending is flat, that means people are spending, are buying less in terms of volume, number one. But the other thing to look at is, okay, so people are continuing to spend. Of course they are, I mean, you're used to buying food, you're used to going to the coffee shop, you have to keep on spending that. But how are they spending it? Look at savings, which have collapsed. Savings were built up during the COVID lockdowns in whenever that was, 2021, 2020, and savings have collapsed. Then look at credit card debt.
Oh yeah, it's skyrocketing.
Exploded upwards. And last month we had we had a peak back to 2001, which was a very short peak, but credit card debt has zoomed. So people are continuing to buy, but they're depleting their savings and increasing debt in order to do it. When the savings are depleted, and for most of the bottom, when I say bottom, for most of the lower 50% of the US in terms of income and net wealth, net household wealth, they didn't really have any savings to begin with. But when savings are depleted and your credit cards are maxed out, then you have to start cutting. That's the next shoe to drop. We haven't quite seen that yet, but come the first quarter of next year, we'll be looking at retail sales declining.
Well, yeah, after Christmas, after everyone's spending, after using all their credit cards, yeah, I totally agree. I truly believe 2023 in the beginning you'll see the first stages of a true hardcore recession.
Absolutely, I agree with you.
Yeah. Well, Adrian, again, truly thank you for coming down to Wall Street Silver. We always love having your input, and then we hope to have you on in the next 2-3 months.
Thank you very much. I always enjoy these chats. Thank you.
Take care.